Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. On today's episode, I'm going to explain the second part of the prospective analysis, which is going to be valuation. And if you've been listening to my episodes, you already know that I've explained to you many methods for doing valuation before. But in my elective, this new elective that I was seeing, I learned a new method. So I'm going to include this new method into all of the other ones that we've seen, and I'm going to explain what are the good things and bad things of all of the methods. So let's do a quick recap, because I don't know if you watched all of my previous episodes or if you watched and you forgot, but we're going to have many different types of valuation. We're going to have the dividend discount model, and this one, even though it was one of the easiest methods and it was one of the first ones that I taught to you, it's not going to be very practical. So this one is not very used in real life. The second one is going to be the multiples model. This one, it's going to be kind of practical, and it compares other companies' ratios or multiples into the company that you're analyzing. It's going to be relatively useful in the sense that it's going to measure how the market is viewing these companies, because what the ratios are telling you is the market view, let's say, because it takes price over something else. So when you're taking this price, it's going to be an estimate of what the market thinks, but it may not be the best method for looking into intrinsic value. So again, this one, not used. So we're left with two that I used throughout this class, and one of them I talked a lot about. It's DCF, or discounted cash flow model. This one is the most common for sure to calculate the present value of all of the future free cash flows that are going to be discounted by the correct discount rate. And here we're going to have the terminal value that is going to be crucial for doing this. So this is one method. I've already spoken about this one a lot, so I won't dive as deep into this one. But there was a new method that I learned that's called the abnormal earnings model. This one, I think it's not as common, but it was the one that my professor asked us to use throughout all of the term. And this one is going to mean that the value equals the book value plus the present value of the expected abnormal earnings. And so this may sound a little weird, but we're going to go deeper into this model. What I first want you to understand is going to be the difference between the abnormal earning valuation, or as it is abbreviated AEV, and the discount cash flow method, which is going to be DCF. So when we take the valuation approach, as I was telling you, the abnormal earnings, it's going to start with the book value. And this means it's the value that is on the financial statements. And then this value is going to be adjusted by the future abnormal earnings. This approach is going to focus on the company's profitability relative to the cost of capital that it has. On the other hand, we have the DCF. This method is going to take the future free cash flows into the present value, so it's kind of relying on the company's ability to generate cash. That's why it's the difference. For DCF, terminal value is going to be crucial. This is going to be one of the most important aspects. For abnormal earnings model, terminal value is going to be relatively less important. It is important, but the valuation is going to start with the book value, and then the abnormal earnings are added. So it is important, but it's less important than with DCF. And so when you have less importance on the terminal value, it's going to make your forecast a little bit more accurate, if we can say. Then also, when we're considering the accounting numbers, the abnormal earnings, it's going to be, of course, way better, because we're going to use book values and earnings as the starting point, while DCF is going to a little bit ignore all of the accounting numbers, such as earnings and book values, because it's using cash flows mostly. And lastly, if we're looking at the economic part, like how intuitive it is, we can say that Abnormal earnings is going to give you more economic intuition because it's directly linking the value of the company's profitability relative to the cost of capital, and then it's going to connect the terminal value into future, while DCF, it's a bit less intuitive, particularly regarding the terminal value, because there is no clear connection to profitability or efficiency when we're looking at this method. So I think because of all of these things that are a bit more technical, a bit more academic, my professor preferred this method because it was more accurate. But in real life, I think DCF is used more. So what we did in my class was always using both, actually, and we were comparing what each of these methods would throw. DCF, I already explained it in one of my previous episodes, so I won't go into details as much, but I'm going to explain how we start doing the abnormal earning valuation. And so these steps are going to be related to what we were doing in my last episode, which is the forecast, because the first step is going to be the forecast of the future earnings and the book values. So you have to do the projections of the company's earnings and the book values for the future years that you're going to do. Then the second step is going to be calculate abnormal earnings. Abnormal earnings are going to be calculated as the difference between the period's earnings and the product of the cost of capital and the book value at the beginning of the period. And so this is going to have an equation. I'm going to repeat it again. Abnormal earnings equals earnings minus cost of capital multiplied by initial book value. So you'll have to keep moving this. You need one extra year, let's say, because you need the initial book value, and then you're going to create this formula automated in Excel, and you can just drop it, but it's going to give you the abnormal earnings.
This episode is brought to you by Audi. The road is calling. Embrace the thrill of the drive with the all-new, fully electric Audi Q6 e-tron. Featuring effortless power, serious acceleration, and advanced Audi tech. It's not just a new EV, it's a new way to experience driving. The all-new, fully electric Audi Q6 e-tron is here. The next chapter of Audi starts now.
I was never really a runner. The way I see running is a gift, especially when you have stage 4 cancer. I'm Anne. I'm running the Boston Marathon, presented by Bank of America. I run for Dana-Farber Cancer Institute to give people like me a chance to thrive in life, even with cancer.
Join Bank of America in helping Anne's cause. Give if you can at BofA.com/supportAnne. What would you like the power to do? References to charitable organizations is not an endorsement by Bank of America Corporation. Copyright 2025.
And then the third step would be estimating the terminal value. So this one is going to be similar to the DCF valuation. You need to estimate a terminal value in order to say what the projection is going to be. And if you don't remember, terminal value is the value that is going to have if we keep going forever. So after a certain amount of year, after 5 years, 10 years, you're going to just get to a terminal value. And this one is going to be what it will be worth for the rest of the years. Alternatively, it can be assumed that the ROE is going to converge to a fixed number in the distant future, such as the industry average. So now that you already have all of this, we would go back into the initial steps of just calculating the value with a DCF. And so what does this mean? You're going to have all of the years of abnormal earnings plus the terminal value one. You'll take all of these numbers and you'll discount them into the present. And so which discount rate are you going to use? The one that we were using with DCF and the one that you would use if you're doing DCF. That is a formula that considers the beta, the market premium, and the risk-free rate. So I'll do a quick recap, but if you don't remember what I'm talking about, you can check my previous finance episodes on valuation. I'll drop the links in the comments. But so beta is going to be how volatile the company is. It's usually a number that's near to 1, so it can be smaller to 1 or higher than 1, but it's going to measure how volatile the company is when compared to the average, to the S&P, for example. Then the risk-free rate is going to be the one that is set by the central banks. So this is the rate at which companies can be borrowing. And then we're going to have the market premium. Different estimates can be done for this market premium. So over here, you can do a sensitivity analysis a little bit. It can be 4.5, it can be 5, it can be a different percent. And so if you take the risk-free rate and then add to that the beta multiplied by the market premium, it would give you the cost of equity or your discount rate. So you're going to take all of the abnormal earnings and all of the normal earnings, and then you're going to bring all of those, you're going to discount them with this rate, and you're also going to be discounting the terminal value if you're using this method. Once you have that, you're going to have the intrinsic value of the firm, and from that one, you can take the value per share. Same thing was happening with the DCF. So you would take all of this free cash flows, you would discount them into the present value, and then you would get the intrinsic value and the value per share. This sounds relatively simple once you have the formulas, and I think this part is not the most complicated of all of it. As I was telling you in a previous episode, the important part is going to be your forecast, because this part is just plugging in an equation. The forecast is going to involve your assumptions. So if you have a good forecast, you are going to have a good valuation. If something is looking weird, first you should revise your assumptions. And again, do a sensitivity analysis to see if you increase or decrease these assumptions or are changing some number over there, how would it affect your terminal value or your total value at the end? Because what this is going to show is the volatility of your predictions. If it's changing a lot, then it's going to be riskier, because if things go correctly, it might be one number. If things go bad, it might be another number. If it's not changing as much, then you know you are on the right track and that you are going to have a correct valuation. And now, after you've done your valuation, there you have it. You already have completed all of the 4 steps of business analysis, and you've already gotten to the valuation of a firm. As you can see, this is a long process that is going to take you a lot of time to do. But I hope it was useful, and if you're interested, you can try it out with a company that you want to get to know better and you want to know how it is acting strategically with accounting, with finances, and all of this is going to lead you to see the outcome. Let me know what you think of these episodes in the comments and share them with someone that also wants to learn about MBA things. If you like this episode, give me a review, and I'll see you next week to explain one last thing about business analysis and valuation.